As you may recall from previous chapters, the cost of goods sold is generally considered the direct costs the business has in order to fulfill a sale. For instance, an electronics store could not sell a television if it did not first purchase a television to sell. The cost of that television is cost of goods sold. This is true of any business that sells goods. The cost of food used in creating meals is the cost of goods sold for a restaurant. The cost of office supplies delivered to a business is the cost of goods sold for an office supply store. Generally, a business that only provides services does not have cost of goods sold. For instance, a bookkeeping service does not usually sell inventory, so it won't have a cost of goods sold. However, if the bookkeeping service also sells office supplies, it has a cost of goods sold whenever it sells those supplies. Determining the cost of goods for business can be accomplished using one or more of three basic methods: specific identification, specs, and percentage of sales. Let's begin by calculating the cost of goods sold using the specific identification method. Of the three methods, this one is the most accurate, although it is also the most arduous to track. This method is typically used in businesses selling expensive merchandise that can be tracked using a serial number, like automobile dealers, equipment dealers, and high-end electronics stores. Consider a simple example from a car dealership. The sales price is the amount for which the dealer sold the car. The cost of sales, cost of goods, or cost of goods sold is the amount the dealer originally paid for the car. The gross profit is calculated by subtracting the cost of goods sold from the revenue or the sales price. So, if the dealer sold a car for $30,000 that originally cost him $25,000, the gross profit is $5,000. When the sale occurred, the dealer entered the sale as a credit to the revenue account and a debit to either cash or accounts receivable, depending upon how the customer agreed to pay for it. The amount for the debit and credit is $30,000. The second part of every sale of merchandise requires a debit to cost of goods sold and a credit to inventory. When a business is able to identify the cost of the inventory being sold, they are able to make the entry at the time of sale using the specific identification method. This entry would be a debit to cost of goods sold for $25,000 and a credit to inventory, thereby reducing the inventory account by the amount of the inventory sold. Using the specific identification method, each time an item is sold, the specific cost of the sale is recorded along with the sale. As you can tell, this method is time intensive, requiring the tracking of each inventory item and the creation of individual entries for each sale entry. Today, computers make it possible for us to use the specific identification method for inexpensive inventory, even if we don't have serial numbers. Rather than using serial numbers, the computer tracks the inventory by item type using a weighted average cost. For instance, imagine that a hardware store is tracking the average cost of a specific type of hinge. The average cost of the hinge was $3.93 per hinge, based on an inventory value of $302.61 with 77 hinges in inventory. The computer updates the average cost every time that type of hinge is purchased based on the number remaining in inventory. So, on January 5th, the hardware store purchased an additional 10 hinges for $45.39. Now the hardware store has $348 in inventory and 87 hinges for an average cost of $4 per hinge. When that type of hinge was sold on January 8th, the sale was recorded for the amount the customer paid and the inventory was reduced and cost of sales entered for the weighted average cost of the hinge, or $4. So, if the customer purchased 5 hinges for $6 each, and the weighted average cost of each hinge was $4 each, the sales entry would be to debit cash and credit sales for $30, and the second part of the entry would require a debit to cost of sales and a credit to inventory for $20. This additional work of tracking the cost and entering the cost of sales with each sale was not plausible before computers did all the calculations. However, we've noticed that even with the high speed of computers today, the labor-intensive work of ensuring the counts and validating that the purchase entries are correct discourages most businesses from using this method for low-priced inventory. The most common method of valuing inventory is what we call the specs method. This method requires that you count the inventory at the end of each period to determine how much remains. The title we assigned is the acronym for the calculation process. S is for starting inventory, P is for purchases, E is for ending inventory, and CS is for cost of sales. Let's begin with starting inventory, which is equal to last month's ending inventory. We calculate cost of sales by totaling all inventory purchases during the period and then subtracting from that sum the ending inventory. This is the simplest method to calculate, and it can also compensate for loss, spoilage, and even theft. Let's consider an example. On June 30th, Rogers Toy and Hobby Store had an ending inventory of $20,000. So it stands to reason that starting inventory for July is also $20,000. Next, we add all the inventory purchased in July. This may be determined through the company's purchase journal, purchase orders, or billing statements, and receipts from the vendors. In our example, Roger purchased inventory totaling $40,000 in July. At the end of July, Roger took a full inventory to determine the ending inventory. The total inventory at the end of July was $19,000. Now let's perform the calculation. To determine the cost of goods using the specs method, we begin with the starting inventory of $20,000. We then add the inventory purchased in July, or $40,000. And finally, we subtract the $19,000 in ending inventory for total cost of sales, which is $41,000. $41,000 is now entered into Rogers Toy and Hobby Books as one entry to debit the cost of goods sold for $41,000 and credit the inventory for $41,000. This brings us to the third common method to determine cost of sales, percentage of sales. Counting the inventory every month may take a lot of time and therefore be unrealistic. Consequently, for tax purposes, the government only requires that business owners count inventory once a year. In such a case, the business may have to use a percentage of sales to estimate the cost of sales on a more frequent basis. It is sometimes more reasonable to estimate the cost of goods based on the selling price and the markup percentage. And most business owners understand markup. Many industries have average markup amounts for the industry or for particular items within the industry. If a business owner buys a product at $10 and marks it up 50%, he will take $10, the cost, and multiply it by the markup percentage of 50%, or 0.5, to determine his markup of $5. Incidentally, the markup is the same as gross profit. When he adds the gross profit and the cost, he gets the selling price. He will sell this item for $15. Ron owns a clothing store. He buys men's dress shirts at $20 each. He marks all of his clothing up 100%. Ron will start with the cost of $20 and multiply it by 100%, or 1.0, to find his gross profit of $20. Gross profit of $20 plus a cost of $20 equals the selling price of $40. Again, to get the selling price, add the markup or gross profit to the cost. Business owners often use markup to determine the selling price. Gross profit margin is a different percentage. It is often called gross profit percentage, or gross profit margin. Markup is a percentage of cost. Gross profit is a percentage of sales. What percentage is Ron's gross profit of the total sale? If Ron has a profit of $20 and Ron's total sales price is $40, he will divide $20 by $40 and get 0.5 or 50%. 20 is half of 40, of course. This template will calculate percentage of sales. Sales minus cost equals gross profit. The template also has two columns, a dollar column and a percentage column. When calculating the gross profit percentage, remember that the percentage of sales for sales always equals 100%. Let's fill in this template with the last calculation for Ron's clothing store. The gross profit is $20. Ron's cost is $20, so the selling price is $40. $40 is 100% of the sale. 20 divided into 40 is 50%. Ron's gross profit margin is 50%. If the sales are 100% and the gross profit is 50%, then the cost percentage or gross profit margin is also 50%. You'll probably recall that Ron was using 100% markup to calculate the price for his clothing. Now we see that 100% markup is equal to 50% gross profit margin. In an earlier example, we used a selling price of $15 and a cost of $10 to calculate a gross profit of $5. $15 is 100% of the total sale amount. $5 is a percentage of $15, so 5 divided by 15 is 0.333 or 33.3%. Simply stated, 5 is 1/3 of 15. If 5 is 1/3 of the total price, then 10 is 2/3 of the price. The cost of $10 divided by the $15 sales amount is 0.667 or 66.7%. When rounding percentages in accounting, we generally round to one digit after the decimal. If you were to go back to the point where we introduced example A, you would see that the markup percentage, which is based on cost, was 50%. Now you can see that a 50% markup equates to a 33.3% gross profit margin. Let's look at it another way. A convenience store has an average gross profit margin of 20%. Their total sales for the month equal $9,600. If the gross profit margin is 20%, the cost margin is 80% because the gross profit margin and the cost margin must equal 100%. The gross profit dollar amount is 20% of the sales price. The calculation would be the sales dollar amount times the gross profit margin. So $9,600 times 20% or 0.2 is $1,920. Calculating the cost can be accomplished by subtracting the gross profit dollars from the sales amount or by multiplying the sales amount by the cost percentage. 9,600 minus 1,920 equals 7,680. And 9,600 times 0.8 or 80% equals 7,680. Either way, you'll get the same result. Basic math can always be checked by calculating the problem in reverse. Subtraction can be verified by addition. For instance, 9,600 minus 7,680 equals 1,920, or 1,920 plus 7,680 equals 9,600. Multiplication can be verified by division. 9,600 times 0.8 equals 7,680, or 7,680 divided by 0.8 equals 9,600. And here's another example. 9,600 times 0.2 or 20% equals 1,920, and 1,920 divided by 0.2 or 20% equals 9,600. This is confusing to many who assume that markup and gross profit percentage are the same. Although they are related, they are not the same. Gross profit margin is a percentage of sales. For instance, 1,920 is 20% of 9,600. On the other hand, markup is a percentage of cost. Gross profit divided by cost equals the markup percentage. 1,920 divided by 7,680 equals 0.25 or 25%. So a gross profit percentage of 20% is equal to a markup of 25%.
So let's summarize the last three examples. A markup of 25% always equals a 20% gross profit margin. And because the gross profit margin plus the cost percentage must equal 100%, then they equal an 80% cost of sales. Likewise, a markup of 50% always equals a 33.3% gross profit margin and a 66.7% cost of sales. And finally, a markup of 100% always equals a gross profit margin of 50% and a cost of sales of 50%, and so on and so on. These gross profit percentages and gross profit relationships are best seen by reviewing the markup to gross profit conversion table in your manual.
In summary, you may calculate the cost of goods using one or more of the three basic methods: specific identification, specs, and percentage of sales. The specific identification method is used for expensive inventory that is tracked using a serial number. This method is used by dealers of vehicles and equipment, for example. Specs is the most common method used at the end of a year, but requires businesses to perform a physical inventory at the end of each reporting period. During interim periods, the percentage of sales method is used to calculate the cost of goods sold. Now, read Chapter 7 in your module and complete the learning activities.